Good morning and welcome to the AUDUSD Securities Markets Update. We have a long day ahead with many economic figures and releases throughout the day, which likely to have a major impact on the markets. But beginning with the Asian session, the previous Asian session, there were a few economic releases across the session from New Zealand and Australia, which had a notable impact on both Aussie and the Kiwi. But beginning with New Zealand, the trade balance posted the first monthly surplus since June of last year by 56 million for the month of January, comparing to a deficit of minus 195 million in December of last year, while the estimates, or it had been anticipated to post another deficit, but not more than before, around 162 million. The exports added more than 3.7 billion, while the imports increased by 3.64 billion in New Zealand dollar. In Australia, the private capital expenditure also came in with another disappointment, declining by 2.2% in Q4 of last year, comparing to a rise of 0.6% in the third quarter of last year, while it had been anticipated also to decline by 1.7%, and this is the first and the biggest quarterly decline since the first quarter of 2013. The Kiwi advanced across the session, or across the board, and also across or against the US dollar, and which basically it continued to rise to as high as 75.77 and remains near the session high so far. However, the pair remains within the same selling area that we noted last week and at the beginning of this week, between 75.34 and 75.34 and also 76.18, which represents its 50 and 61% Fibonacci, or retracement Fibonacci, from the latest decline. The Aussie also tumbled across the board, declining the most against the British pound and the New Zealand dollar. However, the upside, or the upside, is likely to continue in the next few days toward a new selling area, which we believe right now stands between 79.61 and the 80.40, which basically also which represents its 50 and 61% and 50% and the 61.8% on the daily chart. And the US figures could be the catalyst for this potential rally. As for the European session ahead, there are a collection of economic releases from Germany, the Eurozone, Italy and the UK, which likely also to have a medium impact on the market. But beginning with Germany, the GfK Consumer Confidence Index is likely to, or it is expected to go higher toward 9.6 in March, up from 9.3 in February, which would be also the highest on record. The unemployment change in Germany also is expected to decline by another 10,000 in February, comparing to another decline of 9,000 in January, which would be also the fifth monthly decline in a row not seen since last year, or since the beginning of 2014. In the Eurozone, the M3 money supply may rise toward 3.7 in January, up from 3.6 in December of last year, and the year-over-year private loan is expected to decline by 0.3%, comparing to a decline of 0.5% also during the same period. In Italy, the retail sales is expected to show no growth in December, comparing to a slight increase of 0.1% in November of last year. The major economic release during this session especially will be from the UK, as all eyes will be on the second it will be on the second estimates of the GDP in the UK, and the estimates are to remain unrevised at 0.5% during the fourth quarter of last year, which, however, it remains the weakest growth since Q4 of last year, or since Q4 of 2013. Going forward to the US session today, there are a collection of economic releases from Canada and the US, which likely to have also, or will be, the main driver of the markets today, or maybe throughout the week. But beginning with Canada, eyes will be on the inflation figures. First of all, the month-over-month CPI is expected to decline by 0.4% or 0.4% in January, comparing to a rise of 0.7%, which would be also the third monthly decline in a row not seen since the financial crisis in 2008. And the year-over-year CPI is also expected to go even slower, or to slow down towards 0.8%, down from 1.5, which basically we're talking about around like 45% of a decline or slowdown, which would be the lowest inflation rate since October of 2013. The core CPI also in Canada is expected to rise slightly by 0.1% during the month of January, comparing to a decline of 0.3%, which would be the first monthly increase after 2 months of consecutive declines. However, the year-over-year core CPI is expected to decline toward 2.1, down from 2.2%, so it's just a slight change to the downside. As for the US, we will be following many economic figures today, but the important economic releases this week. Eyes will be first on the inflation, in addition to durable goods and the jobless claims. However, beginning with the inflation data, the month-over-month CPI is expected again to decline by 0.6% in January, comparing to another decline of 0.4% in December of last year, which would be also the third monthly decline in a row, not seen since the financial crisis, or not seen since 2008, 2009. And the year-over-year CPI is also expected to dip even lower by 0.1%, and this is the first monthly decline, or which would be also the first negative reading also since the financial crisis, or since 2008, 2009. Eyes will be focusing on the core inflation data today. The core CPI is expected to rise slightly by 0.1%, comparing to no change, while the year-over-year is expected to remain stable at 1.6. Moreover, the durable goods orders may rise again by 1.7 in January, comparing to a decline of 3.3%, while the core durable goods orders may rise by 0.6 after a decline of 0.8%. Finally, the weekly jobless claims is expected to rise slightly toward 288,000, up from 283,000 last week. And here we have to say that any disappointment from the inflation figures or any decline in the durable goods order will weigh on the US dollar again, and sharply, as the growth figures for the first quarter of this year will be revised even lower again, and will push the first Fed fund rate hike to late 2005 instead of the current estimates, which basically is around June of this year. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. Thank you for watching. We'll see you once again tomorrow.